I certainly hope so. I'd like to start with our next session on the panel. We've spoken about the business of trying to build larger financial institutions to meet the needs that we have for raising capital, for intermediating businesses, up and down across the continent, the East, the West, the South, and the North. That was our starting point, right, on Monday. Moving forward, though, how do we build those enterprises, especially at a time when you're seeing a lot more international banks exiting the market, right? We saw, for example, in the last couple of weeks, Standard Chartered saying that they're going to essentially pull out of some markets in East Africa. They're shutting down their operations in Uganda, for example. And they've been in that country for over 100 years. And it's not just a story around Standard Chartered. We saw that with Barclays, right, a couple of years ago. We've seen that with Société Générale elsewhere. But in that pullback, and all the questions it raises around correspondent banking relationships, obviously, there's a very interesting opportunity, right, that comes up for all of our big Pan-African champions that we have in the West, the East, the North as well. So how do we make the most of the opportunities that are coming up? We'll explore that in some detail with my panelists this morning. I want to start by bringing them up fairly quickly in short order. Roosevelt OGBONNA is the Managing Director of Access Bank. Please come up to the stage. He'll be joined by Amine BOUABID, who's the CEO of the Bank of Africa Group. Kamal MOKDAD is the CEO of BCP Bank. And we have EBONG, who's the Deputy Managing Director of First Bank of Nigeria. Ladies and gentlemen, your panelists for this session. Gentlemen, thank you for your time over the next 14 minutes. And I want to start by reframing the question around the pullback, the withdrawal that we keep hearing about so much of, Western banks are leaving the continent. They don't see the risk-reward opportunity in the math there making sense. But specifically in the case of Access, right, I think one of the interesting things about what you're doing is that you're expanding not just within Africa, but outside the continent as well. You're seeing an opportunity setting up shop not just within Africa, but in the US and in Asia as well. Tell us about that.
Thank you very much. So I think what we're seeing in financial services is a reflection of where the market is today. In many segments or sectors in the continent, we've seen the international institutions pull out. Now, you said 100 years in the case of Standard Chartered or several other banks. There are many FMCG companies who have been in Africa for even much longer. If you've grown up in a period where there's a lot of fat and there's a lot of rent, and you've gotten used to doing business under those conditions. Now, when you have locals who are growing and the face of competition is changing, there's always going to be a challenge as to how do you switch from that period where there's a lot of economic rent and you got the benefit of it to now really competing because you have to make direct impact into the markets and the communities that you serve. We've seen that the international banks, like many other international institutions, then don't see that it makes sense or is worth it for them. And then, of course, it creates an opportunity for large African banks to come in and play the role that they've traditionally played. Now, if you really need to replace them, you can't just do that in country because that's not what they represented. For a lot of these large institutions, they might have had a small presence within an African country, but that's not where the work was done. The work was done out of London, it was done out of Dubai, it was done out of Hong Kong, New York, and wherever else. So for you to effectively replace a Standard Chartered, you can't just do that within an Ivory Coast or a Gambia or Sierra Leone, because a lot of those credits or impact that they made in that market was out of London. So for us, we look at our market or our business from three perspectives. The first is ensure you're in global financial markets. That's the first thing. Ensure that you're in global trade hubs. That's the second. And third, build scale within the local markets. Then you can compete effectively. Now, what do we see as a global financial centers? We see 5 as it relates to the African continent. So there's London, there's New York, there's Hong Kong, there's Paris, and there's Tokyo. Our view is that given Africa's play today, we only need to be in London, New York, Paris, and Hong Kong. We're in 3 of the 4. We expect to be in the US, which is the 4th one, by 4th quarter of 2025 on the outside, 1st quarter of 2026. From a global trade hub, we see 5 of them. So London, of course, Hong Kong being the gateway to Asia, Dubai, China, as well as India.
And you're giving me a nice opening into my next question, and this goes to the entire panel as a whole, because more often than not, when we think about building those correspondent relationships, it's always to capitals in the West, right? Paris, London, New York. But what about the Middle East? What about China? Because if you think about the trade flows that we have between a lot of economies here and those economies on that end of the world, there's a lot of trade, right, happening. China-Africa trade is what? The better part of $280 billion last year. And I'm wondering what your view is, right, among the 4 banks represented here on building those trade relationships, right, and setting up shop in China and the Middle East.
You want me to go first? All right. So as I said, we have a rep office in China. We have a rep office in India specifically for this purpose. But the reason we've set up shop in Hong Kong and Dubai to take advantage of that is we find it easier to raise capital from those markets. So in the global trade hubs, we do essentially trade business. The global capital markets, we raise capital to support the trade flows that are going in. So Hong Kong is only to support Far East Asia and trade flows into China, working with our rep office there. Our Dubai office used to play that role before Hong Kong, so Dubai is now focused on the Middle East. And there are many buying houses that used to be in Hong Kong and Dubai. And of course, given our extensions into Mauritius today, we're hoping when we conclude our Mauritius transaction in the 1st quarter of next year to then play that active role working with India. So that's the way we've set it up.
All right. Amine, do you want to weigh in on that question around, the linkages and the setting up, into the Middle East and China?
Yeah, thank you very much. Definitely, like you mentioned in the beginning, banks, European banks are exiting the market, the African market. We have to reinvent the new banking of Africa. It will take time. The mutation will take time. It's not something that will happen tomorrow, for sure. First. Second things, when you look at these countries, for example, you look at France or whatever, UK, you look at the GDP of France, is the GDP of all Africa. So we cannot afford to be having the same size. So we have to play together. We need to bring all investors together. We need to bring savings together. We need to do things together. We have to reinvent this model. We don't know what model will survive tomorrow, but at certain times we need to be involved. Concerning also, today we are talking as African. So our ambition is to develop our countries, not to do the same as the foreign bank were doing. Okay. Today, every day we import, every day we dig our thumb. Okay, so my main objective is to develop my continent. By developing this, that means we need to rethink the model today. Okay, so to do that, we have plenty of challenge to overcome, but we cannot do it alone. We need to have the political will. We need to have of the countries, definitely. We need to have the central bank regulation, not strangulation, to give us more capacity to move. We are facing some challenge that other banks in Europe, they don't have. Financial inclusion, local savings. We have a story to tell if you want to attract foreign investment in our continent. Today it has been mentioned yesterday by the Minister of Finance of Morocco, is 3%, the direct investment in the whole Africa is 3% of the world investment. It's nothing. It's like a broker commission. and you add up if you take up North Africa, it's maybe less than 1%. So definitely we need to have a story to tell, to have a regulation and then to move. Concerning the corridor, we already at the group level, we have plenty of corridors, but there is no regional integration at all. So people, they don't make any choice. So that means everybody has a north-south relations, and there is no business between the countries. Everybody wants to make the same things. So we need to set up the priorities, to see where we want to go. It's important. So all the subject that has been raised yesterday, today, about money, the cost of transfer of money through currency, this is enablers. But it's not, we need to set up the dynamic. And for that, we need everybody to sign on a document saying, I want to bring the level, the contributions of the financial industry in the GDP at a high level.
And we'll get to that in the question around licensing and unifying licensing rules, hopefully across the continent. But Kamal, I want to get your views on this, right? Setting up those trade links, or rather establishing a footprint in Dubai, into China. What's your approach on it?
Thank you, Ramah, but allow me to make my speak in French, since all the speakers will speak in English. Thank you.
It's clear that today there is a phenomenon of exit of international foreign banks from Africa, which poses the problem of banking correspondence. It's an issue that was traditionally dominated by major international banks, and we see that 85% of African exchanges are with the rest of the world. The issue of banking correspondence remains a real issue, of course, with Asia, which remains an important partnership. And I wish to share how we are managing this at Banque Populaire. Outside the important network that has been built and today includes over 900 correspondents with main actors in Asia, we today have a whole dispositif in place to cover the need in banking correspondence of African banks. This is a dispositif that was built around our subsidy in Africa, CBD Offshore, because today with the exit of international banks, most intermediate African banks do not have access or have difficult access to banking correspondence, which is very restricted. So we built a high offer that allows us to play on this bridge between intermediate African banks and international banks in order to make transactions in dollar and euro. And today CIB Offshore is the correspondent of over 30 banks in West Africa and Central Africa and the Indian Ocean, a territory where the Banque Populaire Group is present in Africa. As for Dubai and China, how we are apprehending this, we are building a hub especially in Mauritius, where today the only bank of Western and Central Africa that have a presence in Mauritius. As you know, Mauritius is a hub, an important corridor for flows between Asia, China and Africa, and especially developed a clearing and compensation system. Most Chinese companies today go through Mauritius to be able to be paid in renminbi through a local compensation system, and also to benefit of the non-double imposition conventions between Mauritius and other African countries, because it remains an important hub for cross-border financing, with a series of Chinese actors installed in Mauritius to be able to seize those opportunities of investment and trade between Asia and Africa.
And actually going directly to the market. Any, your views on setting up shop to take advantage of those trade flows between between China and the Middle East?
Well, I think it is clear that the level of economic integration between Africa and Asia has vastly increased. You yourself mentioned trade flows alone are almost $300 billion. The interesting thing is that the underlying economic integration is there. However, the financial system architecture is still very much Western oriented. And what do I mean by that? You'll find that the banks, like ourselves, still rely on largely Western or the global international banks to finance that underlying trade. So I think it's very important, and we will start to see the evolution of much closer relationships between African banks and Chinese banks or other Asian banks to play that role. And hence, it's then becomes extremely important for us to locate ourselves in those critical hubs so that we can facilitate that intermediation.
Because right now, a lot of that trade is happening through a third currency more often than not.
Precisely.
The US dollar, running it through SWIFT, rather than, say, Naira, Renminbi, or Kenya shilling, Renminbi, or Moroccan dirham, Renminbi directly.
Well, I mean, it's not just the currency. It's really the whole financial system architecture. So you're doing the underlying trade, that $280 billion worth of trade, how much went through global correspondent banks relative to African banks or Chinese banks? A very small amount, right? So it's really about establishing those relationships, establishing that integration between Africa and Asia, and building a financial system or using this financial system architecture in a much more efficient way and building those relationships with those banks.
How do we do that, though? How can the 4 banks here represented, for example, step in and provide that dollar liquidity, right, that some of these banks will need, some of these trade institutions will need in the interim, with a view to gradually moving that trade away, from having to rely on a third party in order to facilitate it?
Well, so I think several things have happened. But just before we get there, we also underestimate how much trade can happen within the continent itself. So we're all going out to China and to India. The opportunities to trade within the continent. So the Africa Continental Free Trade Agreement hopes to move intra-Africa trade from 16% to 60%. Now, the challenge is to getting that done, but those challenges are not surmountable. People will tell you about capital, the trust issues, conversations around information, quality. But just think about if we can catalyze enough capital within the continent to allow us trade significantly. We might not get to 60%, but think about where the continent will be if we move from 16 to 30% or to 40%. The Eurozone is at 70+% intra-Eurozone trade. So Africa can get there, right? And then the currency conversations are much easier to handle. We're not going through third-party currencies together. So I think that's one thing we are very keen to pursue, working with the likes of IFC and Afrexim to see how we can get that done in due time. The second conversation around the trades and the currency is, I've challenged many heads of state, African heads of states that I've met. So you all talk about this idea of Africa taking its own destiny in its hands. But when you have your, your reserves, you don't bring it to African banks. You take it back to JP Morgan and to Citibank, and then you ask us to do a miracle to make Africa work. It's not going to work if you are not even willing to trust the banks that are operating within your market to be able to support you to manage your reserves. Now, without calling names, there are 3 presidents who say, this is something we're championing. If you watch the president's interaction with President Macron earlier in the year in Paris, some of them challenged him to say, this global system doesn't work. It doesn't work for Africa, right? And if we're going to change it, certain things have to be done differently. And I think for one, there's no African government who should have any conversation in the room if their reserves are still kept to the international banks. You're keeping your reserves in foreign currency. Those foreign currencies are not placed with local banks or global African banks who can manage your currency. Now, if we get into the room and we're pitching, and there's Standard Chartered, Citibank, JP Morgan, and any one of us sitting in the room, the chance that none of us on this table will get that deal. It will go to the foreign bank. So we have to change the colonial mindset, which kind of associates safety in financial services to foreign banks. That's the mindset we need to change. I think the second thing we have to own and take responsibility for, and I've challenged governments as well, and the AU, the cost of capital for global African banks is 300-400 basis points higher than most banks anywhere in the world. And that delta doesn't reflect the cost of risk.
I mean, to your point, just before we came here, EcoBank, their $400 million note, 10.25%, which for me, I mean, that's a spread of around 600 basis points, which doesn't make sense.
It is not reflective of risk. It's reflective of fear. It's reflective of price gouging, right? But the reason they can do that today is because, I mean, think about it. We give them those monies as our reserves. we all go back cap in hand back to the same people and ask them for the same money, and we pay a premium for it. Doesn't make sense. So I think those conversations we need to start changing. But ultimately, is to get Africa to trade within itself so we don't have to each time go to China. There'll be quality issues at the start, but it's not in every segment of our economy. I mean, I tease my colleagues in Angola. It's easier for an Angola business to do, an Angola customer to do business in Portugal. So they want us to externalize money to Portugal and then bring that capital back in the system. Just think about the stranded capital within the African continent that is sitting in many global banks today that could be brought back here to impact the way the continent works.
On that note, because for us to get to that point, right, easier trade, ability to scale, etc., and I just want to ask all the panelists this question. Given the current architecture that we have, is it possible to have a common banking standard for banks above a certain level of capital across Africa? Do you think that's possible? Yes or no?
Go first.
Go for it.
I think you already have that. So there's no bank. So the way you've posed the question in itself just shows where the challenge is, right? We are no different. And this is what I saw one of the rating agencies here, Moody's, my colleague, a friend of mine from Moody's, and I keep challenging them anytime we're in the room. Tell me why I am different from JP Morgan. You need to convince me, because we go to the same schools. We beat them in class, right? We do the same banking business. We're no different, right? So the system has been rigged to ensure that we never look up. The rating agencies will come and say, well, you trade in your local currency, your functional currency is Naira, XYZ, you need these 100 things for you to scale through. The business and banking practice is no different. That's the truth. We just happen to operate from different markets, and in some markets, the banking pool is richer than other markets. We're held to the same standard in terms of what we do, and even maybe higher standards than those institutions. What JP Morgan would do and get a pass, we can't afford to do the same thing.
So they get a pass and we don't get the
We
distinction.
don't get a pass.
I mean, do you want to weigh in on this, right? One license, one common set of regulations across the board to make this work, to build that scale.
Well, I think we are already there. Like you just mentioned right now, we already set up a standard. The standard is natural. It's setting up by itself. We don't need to go. This is competition. This is offer, supply, demand. The equilibrium is happening. What is important today, I think I would like to come back to, beside the trade is not the essential. I know there is a trade and we'll find a way to capture the trade and develop it. But for me, it's more about to setting a KPI on which everybody agreed. When I said KPI on which central bank agreed, on which bankers, players agreed, on which the government agreed. And this is how we can develop. Because today, the contributions of the financing to the GDP is very low. 25, 26% for Africa, like sub-Saharan Africa. Okay, if you look at a country like UK, it's 120% on GDP. So definitely there is very strong correlation between the development of a country and what we are experiencing over the last 5, 6 years, or even 10 years, we have a growth of the asset very low, lower than the growth of the GDP. So what is happening today is that we are just making a lot of declaration, but nothing's happened in reality because nobody is mobilized on that.
Lots of talk, but it's not translating into action.
Yeah, action. So the idea, if you take, for example, just let's say today we are at 25%, and we would like to be in 10 years at 50%. Okay, let's set an objective. 25% today of the GDP is financed by the loans, the outstanding loans of the economy. We want to bring it to 50% in 10 years. Okay, that means if you take a growth of 5% per annum on average for the country, we'll be at base 100, we have to be at 155 in 10 years. Okay, so if you take this 20%, 25, you want to bring it to 50, that means we have to grow the assets, the assets on the balance sheets by 30% per annum to catch up. 30% per annum in 10 years. Just to catch up, to become. So let's have an ambition. Maybe it's 20 years. But let's set an ambition. And we don't want central banks to look only on the risk side. We want them to start looking at business side. You cannot develop if the cake is too small. There's nothing to develop. We need to grow the cake and then regulate. For me, it's important. So everything comes in normally after. We have the trade coming, you have the operations, deposit, loans, you have even story to tell because we know that the domestic saving is not enough. We need more money from overseas. But we need to tell a story in order to be able to bring that. It should be an ambition for everyone. Otherwise, I don't see how we can achieve. It will be, we're going to meet maybe in 5 years again, and it will be the same story.
Which certainly doesn't help. Kamal, do you know what I mean?
Yes, please. Est-ce qu'il faut harmoniser les standards? Bien sûr que oui.
Should standards be harmonized? Of course, and I will explain why. When we look at the SWIFT statistics, we have only 15% of African transactions that are compensated inside Africa. For most of it, for exchanges between African countries, we need to exchange the money into euro or dollar or pound, and then convert it back into African currency, and this incurs additional costs of around $5. On the other hand, when we look at the dynamic in many African countries, and there's lack of initiative to dynamize intercontinental trade, today we have an imperative of reducing dependency of Africa to African currencies, so we need to move forward in a regulation and payment system in Africa, because for 55 countries we have 42 currencies, so it's very complicated to do exports between African countries in an acknowledged currency. So we need to move forward in a unique compensation system specific to the African continent. We already talked about it, now we need to do it. And it also involves first harmonization of regulatory dispositions and control dispositions. Once we have done this, a more global issue for the issue of dollar liquidity, 85% of exchange needs in Africa are treated with the rest of the world, so we remain dependent on those international currencies. We need to continue work to be able to do this. Of course, all banks do not have access to international banks, so we need to continue going through nesting for downstreaming, which incur the cost because more and more international banks require minimum operations to treat import-export operations. So those fees are dissuasive for African banks. So sooner or later we need to organize ourselves to be able to add the appetence of those banks for African banks through compliancy dispositions. Today the compliancy requirements and anti-laundering requirements can't be avoided. We need to invest also into information system and technology system to industrialize as many operations as possible, because requirements in terms of cost and security and speed are extremely high. And we also need to think at an African level about an aggregation of the payment needs for a critical mass. Today, when we look at the volume of operations, it's not massive enough. We need to get it more massive to aggregate and route operations towards an aggregator that can manage those operations with international banks. And of course, this also requires guarantees on the compliance dispositions. And this is how we can move forward to on the level of liquidity in euro, dollar, and other currencies to accompany those dynamics of intra and intercontinental trade, which we are living on the African continent.
But come to you, Ini, because all the banks on the panel are doing some really interesting things. And looking at the current rights issue, right, that First Bank is carrying out, I know the intent is to take, or rather raise that, the target is $90 million, and roughly 20% of that is going to be funding expansions outside, right, Nigeria. Walk us through what your targets are within the continent.
Okay, in First Bank, our focus is more around Middle Africa. We look at more of West and Central Africa in terms of area of focus, in terms of expansion. So we have identified a number of markets that are of interest to us in that region. And the reasons are simple. We're big in Nigeria already. Nigeria is a large economy. But you do want to diversify. You do want to follow your customers. We do want to look at other banking pools that are of interest. If you look at the middle of the continent, countries like the DRC, Ethiopia, Angola, there are a lot of opportunities, a lot of markets are opening where we're seeing financial markets, financial systems expanding, kind of like what we saw in the early 2000s in some of the larger African markets. So we believe that it's an opportune time to partake in that phase of growth that we see in the middle of Africa, and that's our area of focus.
We're going to open it up to the floor now for any questions that you may have. I believe I can see one gentleman in the far left. Do we have any roving mics in the room at the moment? Yeah, there should be one coming your way now, just behind you over there. So we're going to go to the gentleman in the far left, and then we'll come to the gentleman in the front row, and then we'll start from there.
Good afternoon. Rodi Sodiri with Rise News. I just wanted to pick the brains of the bankers here of what a unified currency, the role that plays in boosting trade. Because you mentioned wanting to get trade in Africa from 16% to I think 70%, where the Europe is, but Europe has the euro. And of course, different countries on the African continent use different currencies. Much of the francophones are pegged to the euro, so their inflation is lower. So, and then there's, of course, the issue of monetary policy and so on. So is that part of the conversation in trying to get trade boosted in Africa through the banks?
Do you want to attack that?
Yeah, so I could. So yes, it's necessary. You're right that the Eurozone, the reason why they've made a lot of progress is because there's a single currency. If you remember, within West Africa, we talked about the ECHO. We wanted to create our own currency, and the idea is to just remove the structural barriers that currency and monetary policy portends. But I think the AU is doing some work on that. I don't know how far they've gone, but even without that, I think having banks like us on the stage who are spreading across Africa means that that conversation could be out of the room. And the reason I say this is that today, if you're a customer in Botswana and you want to do business with another customer in, I don't know, DRC, right? You don't need to talk about the dollar because Access Bank will play the mid-treasury role. So for the Angolan customer, it's a local transaction. For the Access DRC customer, it's a local transaction. So currency is really not the conversation. So that central treasury will play the role, right? If we can get Africa to the point where we have a single currency, excellent. But if we can't, I think given the way we're structured today, we can still achieve that, right, without necessarily waiting for that currency unification to happen.
Anyone else want to weigh in? Sure.
I think one of the biggest fallacies that exists is that there's limited intra-Africa trade. And, you know, it's not quite true. I mean, if you, especially across sub-Saharan Africa, go to any border town, you will see the amount of goods and services that flow across these borders. Transactions do happen, and those transactions happen in African currencies. So if you're in Nigeria, it will happen between the CFA and the Naira. It's freely exchanged at the border. People price, people determine what that Naira CFA exchange rate is, right? The challenge is it doesn't flow through formal channels. And that's really what we should be asking ourselves. And again, when we sit with regulators and some of the things, the key concern for me is that we're not spending enough time, or the regulators are not spending enough time in analyzing what are those restrictions that prevent these things from happening, right? To formalize this trade so that a bank in Nigeria will transact with a bank in Benin Republic formally and allow these trade flows to pass through formal channels. Now, a lot of it is tied to regulation. In some ways, I think our regulators tend to be perhaps a little too nationalistic when it comes to exchange controls. And I think we need to step back and look at ways to find ways to streamline these and relax some of these rules. And if we did that, I think we should be able to capture a bit more of these flows. I think we're very far away from single currencies, whether they're in regional blocks or Pan-African, but that shouldn't be an obstacle. Exchange is but a number, right? If we create the systems, if we remove the restrictions, then we'll be able to transact freely across markets.
Very quick question, just to piggyback on what he asked. It might take a while for us to get to a point where, we're talking about common currencies and so on and so forth, but can we just start from a regulatory perspective by saying, if Roosevelt is licensed to operate in Uganda, as a regulator next door in Kenya, I will recognize that licensing, right? Which essentially eases access to getting to market X, Y, Z.
Well, so I mean, I don't know if there are regulators in the room, so... I mean,
No pressure.
So the answer to that would have been yes, but we do recognize that different markets have different regulatory regimes, and there are different stages of development. So what the regulator is focused on is slightly different. Now, the truth is that there have been several African markets that we've walked through the door into the central bank, and the question is, when do you want to start? Right? Because there's recognition that you're in this market, you're in that market, so we give you already the benefit of doubt that you are a strong financial institution, and if you can operate in what we consider the most conservative regulatory regime in the world, which is Hong Kong, HKMA, as far as I'm concerned, I'm not sure who is more conservative. You operate in the UK, some of these institutions operate in China and the US, then I'm going into another market, and they're asking you the entire question. So the regulators should go through the process, because there is a process. But I think there should be benefit of doubt that is given when you see an institution is global, might be African in origin, but in operations is global. I'm not sure you have the same conversation with a Citibank or with a Standard Chartered, but we still find, and this comes back to that point I keep making, if an African bank goes into a new market and is there on the same day with a CT or JP or Standard Chartered, the regulator will receive them differently from how they receive us. They give them the benefit of doubt. We have to go through the ringer to get a license. Now, we don't mind that, because it just makes us stronger, right? Because each opportunity is a test to just confirm that what you're doing meets all the banking requirements. But hopefully someday, banks like us will get the pass that when we get into new markets within the continent, we're welcomed, and that we're seen as a force for good, as against sectional conversations. This is a West African bank or an East African bank, a North African bank. Sadly, those conversations still happen.
There was a question in the front row to the gentleman right here.
Thanks very much. My name is David. I run a startup called Jabu. We're a fintech digitizing cash. So we put money in the machine and we give you the value instantly in your bank account. We're actually working with Access Bank in Zambia. And congratulations on expanding to Namibia. And I can imagine your process is exactly what you just described. We've raised a lot of money from venture capital in the US. And a lot of your experience that you share here, it's very similar for fintechs trying to do this. But when we tell venture capital firms that we're about to go do business with commercial banks and we say your names, they look you up on the stock exchange and they say, whoa, they have a 2x PE ratio. That same venture capital mindset is the same capital markets mindset that looks at Bank of America trading at 16x PE ratio. How do you feel about that comparison tool? I've had endless fights with venture capital firms trying to explain that you're legit, that you exist, that you're liquid, that you're profitable. But they look at your PE ratio and they dismiss the potential of the market very quickly when they compare it to like global banks' PE ratio.
Kamal, do you want to start on that one?
I will speak in French. I don't know if it's very relevant. You understand French? Yeah, okay. So, donc la question c'est sur.
The question is on the evaluation of the tools to understand how to evaluate the business and the depth of activity that can be done in Africa when we look at the ratio and evaluation of a startup in the catch field, cash monetization for banks, for bank comparables. Is this the question, just to be sure? Give him the mic, please.
En Afrique, c'est 2 fois, 3 fois price to earnings. Mais quand il voit les mêmes banques,
The price to earnings ratio of a bank in Africa is 2 or 3 times elsewhere, and trading banks do 12, 13 times the same rate. This is a reality. We can see it in Morocco. The many evaluations are very high in Africa compared to other regions. It's usually explained by potential of growth and higher income in a market that can be more dynamic and more mature. It can also be due to insufficiencies in the number of quoted entities, as we can see in Morocco, because we see a higher demand of investors on certain values than the available values on the market. This can create tension on valorization, but it also needs to be seen as opportunities. When we can benefit from those valorizations, it can be leveraged on capital augmentation to finance higher development in regions in Africa. This needs to be analyzed in this perspective. So today, for those banks that are in a continental growth rate to meet the expectations and fill in the emptiness, the void left by international banks leaving the continent, we have this opportunity to go to stock exchange. And here I am looking at my friend Farik here in this room. It's Ibrahim, the president of the Board of Advisors. Those opportunities of stock exchange introduction are really interesting to mention in order to finance external development on the continent.
You're not right what you said, that the valuation of banks in Africa are more expensive than banks in the US. It's the opposite. Okay. So it is trading maybe at 4 or 5 times earnings, and sometimes in a country like Nigeria, even at the price to book, they trade below book value, half book value, something like that. Okay, so it's just the problem is liquidity, because people, they get in, they cannot get out. So that's the real problem. And there is no volumes. So we need to build up volumes in order to make it happen. Concerning the previous question, when you mentioned about the regulations in Eastern African countries, it's very, very difficult. Because today, even when you have an independent directors in one country, and you said, I want to put it in 2 countries because I want to share the cost of travel, the cost of hotels, and blah, blah, blah. They said, no. He's independent, he has to be in one country. So you have to manage the ego. It's not easy, situation. But that's the reality we are facing today. And it is over-regulated. And this is the country when they have the most bankruptcy of banks. So sometimes we need to ask ourselves. And sometimes we even question the independence of banks. But when we see a country like DRC, for example, for instance, when you look at the balance sheet of the industry, only 1/3 of the deposit benefit to the country. 1/3. 1/3 is bought in bonds outside the countries, and 1/3 is in nostro account for trading facilities. So in reality, people, they open banks, they take the savings from one country, they bring it to another country. That's the reality. I'm just pragmatic, and that's the reality. I say it to the Minister of Finance. That's the kind of regulation. We need to at least give the opportunity to country to leverage its own savings.
And that's not happening right now. Fun fact, there are some banks listed in Kenya right now that are essentially trading below book. So, if you have a loose $300, $400 million, there's some banks to be occupied. I know there was one last question. Yes, there we go. So we're going to take that as the last question. And I'll put my last question to the panel, and we'll run through the remainder of the session. There should be a microphone coming your way, to the gentleman in the middle row.
Thank you very much. My name is Mohammed Al-Mokhtar from the National Bank of Mauritania. It's a private bank, not a public bank. I have a question related to the issue of compliance. We have recently, several countries in the region had their US dollar account cut or completely closed down because of the issue of compliance. But we know, and I'm going to be straightforward. I will break the ice without window dressing. There is more money laundering in a place like Dubai than the whole of Africa, and yet Dubai has a AAA rating by Moody's. So how can we mutualize our effort in order to tackle that issue?
All right. Gentlemen, no pressure.
Who's going to take that?
Well, I think it's back to the same conversation in terms of double standards. And it's a reality. I mean, we can cry and belly ache all we want, but that's the reality of the global world that we operate in. So Dubai will get a pass. Yes. I mean,
So, whether it be Sudanese gold, Russian money, or Iranian oil, we know that Dubai is a huge place for money laundering. Yet a country like Nigeria is not treated the same way like a place like Dubai.
So I guess the way I look at it, right, we can barely ache all we want, is our reality. Within the context of that reality, how do we succeed? And I think that's the mindset we as Africans have to have. I'm not willing to play second fiddle. I know that the bar is much higher for institutions like us. In that reality, how do we win? If that's not the mindset, then we're playing into the stereotype, right? We're going to keep belly aching and saying, well, the rule is not the same. Yes, the rule is not the same. That's the reality, right? So we just have to hold ourselves accountable even much higher. Right? We want to play in the global stage. That's the fee we have to pay. Now, are we going to fall foul? Sometimes the answer is yes. But I think collectively, we can hold ourselves accountable to much higher standard. Now, the regulator is also helping. In our case, for instance, there's something called the College of Supervisors. They meet once in a year. The benefit of that is that we have all our regulators in the room. So there's no regulatory arbitrage. The UK regulator is there. HKMA is there. All the African regulators are there. Hopefully, ECB will join now. We just started operations in Malta. And we have one conversation. Now, so you can't behave badly in one market and think you're going to get away with it. It doesn't matter if it's your home market. The European regulator is there, ECB is there, everyone is listening, and they're holding you accountable to much higher standards. I wish I had better news for you. I don't. The reality is that's the scale of the problem we need to, or the hurdle we need to get over to be able to play in this global space. And we have to just do it, otherwise we'll be kicked out.
And unfortunately, on that bombshell, that's where we'll have to leave the session for the time being. I know this conversation still has a long way to go. I apologize. We won't have much time. We've already gone way past.
Can I have one question? I'll have it very quickly.
No, unfortunately, we can't. But these gentlemen, of course, are going to be here for the remainder of the session, so I'm sure we can have those conversations, right? Sure. Offline. But I can't say thank you enough to the four gentlemen on the stage, and of course to you for your time and attention. Thank you very much. Have an amazing day.